Live. Welcome, everyone. Another Market Insights. So last week, we just started off with our debut, and we're continuing again once more. What would you say the summary of this week is, in your expert opinion?
Well, I think last week we focused mainly on potentially a peaking growth and around this time. And if anything, we've had confirmation of that this week. So the subject matter this week, I think, is going to be much more on supply and demand for equities in the market, because it's quite probable that we're now getting a peak in supply relative to demand, which is also a very powerful consideration. It's been driving the markets for the last 2 decades, and it's a material change.
All right. And we also had an article that we came out with this week.
Right.
Shall we start there?
Yes, sure.
All right. So this is the oldest practice of money. The dollar's decline is systematic. You do love your systems. So if the dollar is declining, what makes that a systematic change that's happening? In just a few sentences, how would you say that?
Well, it clearly is systematic, because that's what we have observed for 3,000 years in every fiat currency. So it's not an accident that every fiat currency declines relative to the dollars. But what is not understood properly, I think, is that it's actually a systematic process, which really changes how you should think about your investing. You're going to get a different impression about how you're doing and your wealth and your purchasing power if you don't recognize that you're basing your asset prices in US dollars, which are declining, let's say, 10% a year for the last 25 years against gold. That changes how you should invest, and it changes the dynamics of your purchasing power, which is why you're investing. So this is the element that people are missing, and it's very important to understand.
Right. And Ray Dalio would agree with you. If you don't own gold, you don't know the economics or history of it.
Absolutely. Absolutely.
So I think it's best to just get into some of the data and then put it together as to what is this system that you're talking about, because that can seem kind of abstract without some core points. And our first chart here, I think this always stuns me to look at this chart. Talk about declines. The dollar down. This seems to be happening across every fiat currency, but the dollar is the one that I use, you use all the time. And just looking at this chart, if this was a stock you owned, this would be a shocking chart to look at. How has this happened, and how come people aren't talking about this more?
It essentially, when it comes to running an economy, the way to solve the problem is typically the easiest one for everyone to do and absorb. And although people will make out that the dollar system, or whatever fiat currency it is secure and sound and all of those things, it's always going to be the weak link of the system, because to solve a problem you have to borrow more money, or you have to allow a devaluation. And borrowing money is really just delayed devaluation. So they're really the same thing. and it amounts to persistent periodic pressure for the policymakers to use that weak link, and it's always the currency that declines. But if you measure everything in that currency, you don't see it. So you need a measure to understand this dynamic. And the measure, of course, is gold. It's not the one that I've chosen. It's the one that people have chosen for, at least 3,000 years. And that shows it
Right.
up. And here it is. And it is truly remarkable. I mean, we've had a 99% devaluation of the US dollar since 1971. And not many people talk about it, and they should be.
Mhm. So, if I'm hearing you correctly, the reason why we're not talking about it is because we're always thinking about the world from a dollar perspective. You go out and you buy your groceries, you pay in dollars. You go to the bar, your tab is in dollars.
Right.
But and when you look at the markets, all of the main news channels are set on the understood assumption that we're measuring against dollars. Are you saying that that's why we can't see this graph because we don't think of it in that way?
Yes. I think it's really a time factor. People feel emotionally um, charged when the rate of change of things is shocking.
Mhm.
So if you devalue the purchasing power of the dollar at a slow rate, people will shrug their shoulders and say, "Oh well, I don't like it, but it's manageable." And the my grocery basket is 30% higher than it was 5 years ago. They can shrug their shoulders, but if it's very dramatic, then you'll get a riot. So the job to do is to it's going to go down because it's the weak point, but you manage its decline so that people kind of accept it.
Mm.
But if you're investing for your retirement or for the long term, it's a factor you not only can you not ignore it, it's the primary thing you're trying to do is to preserve your purchasing power and grow it so that when you retire, you have a comfortable retirement. If you're not
Mhm.
factoring this in, you're missing that vital component of investing.
Right. Okay. Well, then let's look at a few other examples, see if we can start building out the system. So now we're measuring in gold. This is not the standard S&P chart that you'll find. This is against gold, and it seems to tell a very different story than always trending up.
Yeah, I mean, we're persistently told that the standard conventional investment advice is you need to have a lot of equities, and the more risk you take, the better off you'll be, and all these mantras. But again, you don't escape the devaluation of the currency that you're measuring your equity gains in, because your equities are going up against the dollar. And this describes it since 2000. You're down 69%. That's a huge give up. You could have just owned some gold and you'd be multiples better off in terms of your purchasing power. And yet everybody believes they've done well being in the stock market, completely missing the underlying issue. So people who are not investing in gold, and frankly, most American investors have a almost insignificant gold allocation, about one,
Mhm.
2% at most on average. So this people are missing the point here in a material and important way.
Well, it seems that people are generally wanting to invest in something that's going to have a story of a meteoric rise rather than it seems to me that investing in gold is almost betting against the system that you're in. Is that a fair assessment or is that a mischaracterization?
it's protecting you from the devaluation. And I, I think you were maybe referring to the excitement of short-term gains. And, that's a very dangerous way to think about investing, which we've covered in other areas.
Sure. I'm not actually talking about short-term gains though. I am talking about like people love investing in tech stocks or new things that are coming out. Gold is a very old thing. We've known about gold for as long as we've had books. And that's a very long time. And so I wonder, I'm just trying to get in the headspace of if you're thinking about investing mid to long term, why is it that the allocation of investors is so low in gold? Like how do you explain it?
Well, I think we explain it if you want to get into the detail of this argument, or this article. We do go into how it's managed that way. But I'm not saying, equally, we're not saying that necessarily you should have 100% in gold. And I'm not saying you should never invest in tech stocks either. There are some great investments. You should have a significant portion of your allocation in equities well managed. And that's almost a different subject, but you want to be diversified. The way you compound is you lower risk two ways: by making sure you don't have a drawdown and you have diversity of assets. And certainly equities are a big part of that. I think the commodities are a big part of that. But commodities in general, other than gold, have not performed very well over the last 20 years. And so maybe generally commodities are a more specialized allocation. Yes, I think the short point is you should be diversified, because that compounds, that helps your compounding. But you shouldn't ignore the gold allocation because it's crucial, and it should be central, not an afterthought, which it currently is.
And it seems and later in the article, I guess we'll have a better opportunity to dive further into that original question. But let's continue building the data. So home prices, this is something everyone cares about.
Yeah, I mean, everybody feels that green line,
Yeah.
and it looks great. That's your house price. It's your main investment. Hey, it's going up. You'd be a fool not to invest in housing, right? All your
Mhm.
lifetime. Well, then you look at it, the houses relative to gold, and you see, I think, you've lost half your value since 1970, and again since 2000, by by owning a house relative to
Mhm.
gold, and that doesn't even account for the cost of having a house, which would actually make that diagram look worse. So people need to realize that. If your goal is to preserve, protect, and grow your purchasing power in retirement, which I believe it is for most people,
Mhm.
then you have to be aware of this. It's so important.
And it seems like the necessity in people's minds in America for home price goes up. And I don't care how much you need to change a graph to me feel that way. Seems to be a predominant narrative, at least that I've seen. Um, is that partially responsible for uh, this difference in the two lines, uh, or is it literally just the dollar collapsing?
Um, I think it's behavioral. I mean, I think that people want to have their own home and own their home, and there's nothing wrong with that. But how you allocate your assets, I mean, if in a way, if you bought it on leverage, which most people do, they have a mortgage, then your equity going in has actually multiplied dramatically because bonds have done even worse than houses. And you've dealt with the decay of purchasing parity by borrowing in bonds. And so that amount you initially invested in was leveraged very successfully due to the decline in purchasing power of the dollar. So you have an offset there, which helps you, but don't think that just owning a house from cash is necessarily a great investment. If you're not renting it, if you're not using it somehow, or you're getting an income from it, and you're not beating gold, you can be fooling yourself with a 5% yield if the dollar is going down at 10% against gold.
Right.
So you just need to look at it in the right way, and then that next chart is showing what's happened in bond terms, particularly.
Yeah, you had mentioned that a little bit before. As the we did the interview of you on the YouTube channel of being the UK bond guy, so you know what you're talking about when you're talking about bonds. How bad is looking at how bad does this graph make the reality of the US bonds market look?
Well, I mean, where have we gone? We've gone from 3 to just above 0.5. So if you own a 20-year government bond, what you've gone down, 80% and more. That's the amount you've lost relative to gold since 2000. That is breathtaking. And it's not coming back. And this is a very important chart because 401ks typically it's a 60-40, 70-30. A very substantial proportion of people's investments is going directly into bonds, and they've lost 80% of their purchasing power in 5 years. That should be a scandal for anyone investing in a 401k that they did that and they didn't risk manage it, and they're still doing it. That should be unacceptable, and it's not balancing their equity portfolio. It's just losing money. So that's something that people really should think about.
Yeah. I mean, bonds seem to be, I've heard so many different people recommend investing in bonds rather than other things for the security of all of it. This does not seem secure in the broadest sense of that term.
Right, and there's a very easy solution to this. We have Treasury inflation protected securities. You have a completely different outcome. So instead of buying conventional bonds, you can buy Treasury inflation protected securities, less than 5 years, 5 years or less, and you've had a completely different outcome. And you're actually protected against the CPI. So if the inflation goes up in CPI terms, you're going up exactly with that. And in addition, you get a real return on top, currently about 2%. So how a 401k administrator continues to invest in fixed income government bonds when they have a simple solution is, frankly, it's incompetence.
Fair enough. So, as you were just saying that you've already laid out one other option, but basically there's always opportunities even when we have all of these downward graphs. So tell me about some of that. Other than securities, the ones that actually go up with inflation, part of this is learning when and how to allocate to gold. You mentioned that a little bit. Is there any brief, uh, I guess, advice or way you would frame thinking about it?
I think we can only talk broadly about that. I mean, you can get into details, but if you basically diversify into assets which are going to preserve and protect and grow your purchasing power, then the diversity is part of limiting drawdown and maximizing compounding.
Hmm.
And really, if you were more careful about how you invested in equities, you had Treasury inflation protected securities, and you had gold. And it depends how active you want to be. Then you could have done so much better. And that continues to be the case. I think these issues are now accelerating
Hmm.
because of the state we're in. So I think it's really just a matter at this level, think about diversifying more intelligently and risk managing.
Hmm. So I guess, you were talking about the main reason we're seeing all of these things is that there's massive manipulation happening behind the scenes. How would the general person be able to determine that?
Um, well, I think it's very hard because you're told one story and the evidence is that the dollar is not being the purchasing power of the dollar is not being protected. It's being managed. And so that basically means that second paragraph is a one line. The policy discretion, as stated, is pretty much failing. Yeah, and even, I mean, they're committing to a 2% devaluation a year, but they're delivering a 10% devaluation relative to gold.
Hmm.
And in the last 5 years, the CPI has been above their objective of 2% every month. So they've missed it by a mile. And currently, the latest CPI print we had this week is 4.2. That's not 2%, which is the objective.
Hmm.
So it's not hard to see that they're just not executing. They're not delivering on their promises.
Right. Fair enough. Um, so this is you've been talking about also just the suppression of the price of gold over time. How does could you describe a bit more as to why that's happening and how it's happening?
Well, yes. I mean, um, uh, the people who benefit from fiat currency are not necessarily going to want to bias their clients um, towards um, an asset that doesn't benefit them.
Mhm.
And if a large allocation goes to gold, which you don't trade or anything, then you don't need that to be managed. So it affects AUM. But certainly, if you invest in an annuity with an insurance company, you try look for a gold option. I doubt you'll find one. So it's not even given to you as an option, which I think is a major problem. And banks would prefer they live off deposits, right? I mean, they leverage deposits as that's their business plan. So they don't want you to notice that necessarily a deposit is not giving you much of a return, and it's also massively devaluing against gold.
Mm.
That's not in their interests to encourage that. And here you see the current correction in gold is coming with a collapse in open interest. Now, this may sound a bit technical, but it's just natural that people like markets that go up. And so what you see is positions generally are attracted to an asset which is going up. And so what you're seeing here is something very unusual, which is the gold has been going down, and it's going down with almost no positions at all. In fact, the lowest positions we've ever seen. So there's nobody left to sell, but it's still going down. That's extremely unnatural. That you see no open interest. Markets go down because people are long and they have to sell. In gold, people haven't been that long, and now they've been less. Now they're less long than they ever have been before, and it's still going down. So that means that this is a controlled situation where the market has no participation, and the price can be set by people maneuvering the paper price. And that's it's just an unnatural situation, and it's endemic of a market that is being discretion is being applied. So that's a bit technical, but I think anyone who trades it knows that it's a challenge to trade it, but that doesn't mean that there isn't a way to do it.
Right.
So enough said on that, I guess.
Fair enough. I think, you've been talking about buybacks for the last few months, usually in the corporate sector, but there's also U.S. Treasury buybacks.
Right.
What is the significance of this?
Yeah, I mean, the government cannot afford interest rates to go up, and because we're already spending 1.3 trillion on interest on debt, and that's clearly on its way to 2 trillion, which is our budget deficit. So imagine our budget deficit is all going just to pay interest on debt. It's not actually providing a service or paying people's pensions or anything. So this is a major problem. So they don't want the bond market to go down, and they don't want any acceleration of the bond price going down. They want to stop it immediately. And this chart shows you evidence that that's exactly how the buybacks condition, which are operated by the Treasury, are operating. You can see every time the move index goes up, volatility of the bond market goes up, and typically it does it on the downside. The Treasury accelerates its buybacks to stop the market going down. So you can see that a lot of these markets are not natural markets. There's very clear correlation going on there. So you need to be aware of that.
Fair enough. And then I guess the other thing that's happening less internally and more externally is the oil prices. And I would assume the blockade on the Strait of Hormuz is the main driver in all of this. But this other aspect of the economy seems to play into this systemic picture of everything. How are we to take this into conjunction with everything else that we've been reviewing? Why is this important for understanding the system that is causing the US dollar decline?
Well, clearly, there's a drawdown in inventories that has to happen. And ordinarily, if there's less supply, the price goes up, and that's essentially how oil started behaving. It had a huge rally, I think, from the 60s up to 100 and a bit above. So that was a natural development. However, since then, Oil has actually even been coming down. And, it's simply not reflecting what is a continued acceleration in lack of supply. There's inventories that continue to draw down, but suddenly the oil price is going down. Using the inventories is a high risk strategy, because those special petroleum reserves are really there for emergency when we actually have a shortage. They're not supposed to be to suppress the price, but politically letting the price of oil continue to accelerate as the shortage continues to build, as the Strait of Hormuz stays closed, the price should be continuing to go up. But the price has now been going down, even though the inventories continue to fall. And on many experts' opinion, is likely to hit bottom probably sometime in the third quarter. So to do this drawdown and manipulate or contain the rise is a very high risk strategy in favor of manipulating or containing the rise in the oil price.
Fair enough. So this is just one more place in which prices are being manipulated for the sake of what, the narrative, the visual way in which the economy is
Political
is
expediency, yes. I mean, it's if there's an election coming up, one of the things that immediately impacts people is the price at the pump, and it's they hope to contain it, but we'll have to see. But they're taking a high risk strategy. If these the Straits of Hormuz is still closed in 3 months from now, and it's actually been pretty much over 3 months already, then the problem is going to become even more acute than it would otherwise have been.
Fair enough. So what would you say, if you had to summarize what all of these different graphs say in just a couple sentences? What was the key takeaway that we should be receiving from all of this information that we normally don't see?
Yeah, the key takeaway is that ultimately we know what is going to happen to the price of the dollar relative to gold. It's not just evident for the last 50 years in the US, it's evident to every fiat currency in the last 3,000 years. This is just the way this works. It's systematically. And everything that policymakers do is to contain that devaluation. And for obvious reasons, it avoids them losing complete popularity and control over the economy. So these policy discretion movements are just part of a managed currency, but don't be fooled into thinking that there's a solution. It's basically controlling the downtrend.
Fair enough. Bleak.
Well, it's an opportunity too. I mean, it's great for people who've been long gold at the right time. It's great for people who position themselves correctly, because they're not being instead of your equity markets equity position going down, you could have been allocated better and have 2 or 3 times the amount of money you have today. If you understand the system, they're just winners and losers. This isn't necessarily a doom thing. It's just the clear fact that you need to take on board to invest successfully in the long term.
Right. So it's perhaps the worst time in a long time to be a naive investor. But if you actually learn about everything that's happening now in the context of history and with the right lens to view it, the opportunity is in capitalizing on the rampant like incorrect positions people have.
That's right, because the valuations against gold is accelerating. If you can look at a chart over the last 25, you'll see that since I guess 2020, it has accelerated dramatically. And you have to ask yourself at this stage, at this level of debt, at this level of a bad record in terms of containing even the CPI,
Mhm.
how are they going to fix this? And with debt higher than it's been before, it's going to be very hard to do that.
Fair enough. All right. Well, I think we've thoroughly covered the featured article that we just put out.
Right.
Now, I think it's probably best to switch over to talking about what's happened this week in particular. Obviously, we were just talking about the war is still going on, and so oil, that stress is still happening. But also in new news, Elon Musk seems to be on track to being the first trillionaire.
Yep.
How do we process this? What does this actually mean for the markets and for how we should be positioning ourselves? Should everyone buy the new? Is it Tesla? Is it SpaceX? What's the merged
SpaceX.
stock going to be?
SpaceX. Yeah, that's right. Which I think contains. Yeah. Anyway, so yeah, I mean, I think this is also another turning point. Last week we said that it looks like there's a growth peak coming in. It's been very strong second quarter, but increasingly it's likely, as from the graph we showed last week, that the third quarter is going to start slowing, and into 2027 it's likely growth is going to become a growing problem compared to the growth that we've had this year. It's going to be tough for it to look good. But yeah, so there are a number of the main drivers are not just growth, but also the flows.
Okay.
Is the supply of stocks too small for the amount of demand for stocks? And pretty much we can show that that has been the case for the last 20 years. It's been a contributing factor to the rise of the US stock market in dollar terms. But if that may be about to change. And really, after June, the amount of US equities that need cash on these IPOs, SpaceX being one of them, but also Anthropic and OpenAI and others, that you can see here's the equity from IPOs this year. It shows that it's gone up very dramatically. It's a record in the last 20, almost 30 years. That's what the graph shows. So the dynamics is changing. The other thing is that there's been a huge amount of government bond issuance with the rising debt. And that now is going into a big refinancing period. We have to refinance something like 9 trillion every year. And that needs also a huge amount of cash to complete. So the dynamics of the demands on cash relative to the supply of equities, that dynamic is changing. There's much more equity supply, and there's much less liquidity that's in the market generally to buy all that issuance. So that is a very important inflection point that the market is going to have to absorb starting in June in particular. And you can see there's another tweet below, which shows how liquidity is actually declining already.
Let's see if I can find that one. Oh, is this the one that you're talking about?
Well, let's talk about, since we've got that up, let's talk about it too. The only thing that can stop a liquidity decline is a rapid expansion of money supply. And what has been supporting the markets, in addition to very strong growth in the second quarter, is the money supply is now growing strongly too. And this was just a recent week. You can see a 5% increase, and in a week, and over the last 3 months, a 6% increase in money supply, or at least the Fed's balance sheet, which is an element of money supply. So I think the authorities are gearing up, realizing there's a liquidity issue. And this is the main tool that they can use to change the dynamics of liquidity. So
Right, you can always print more money.
Right. So if this goes crazy, then yeah, the markets can continue to go up. But if money supply starts growing even faster than it is already, then you're not going to be able to contain inflation.
Right.
Simple as that. So these are the dynamics that the Fed's going to have to manage, Fed and Treasury. And I'm sure that everyone is going to be watching Kevin Warsh next week when he has his first speech as the new Fed chairman, and what he intends to do about it. So yeah, it's a good prelude to that speech next week.
Right. So when you're looking forward to a speech from the new chairman of the Fed, like what goes on in those speeches? What do you expect that he'll announce?
Well, I doubt he's going to be in a rush to cut interest rates. I think a lot of policymakers would like that to happen to help finance the deficit. But clearly, with inflation printing at 4.2 and their target being 2%, they're more than double the inflation target. And there's another chart in there which shows that, if anything, central banks around the world are raising interest rates and missing their targets. So for the US at this particular time to rush into a rate cut wouldn't be received very well. And I think it would frighten investors in terms of the inflation outlook if they were to cut rates. So I think he's gonna have to be very diplomatic. He's probably not going to want to raise rates, and basically buy time to a decision. So I think he's going to hedge what he's going to do, and he's going to sound, if anything's hawkish without being too hawkish. He doesn't want to scare the markets too much, but he needs to sound somewhat hawkish to have some credibility. So he has to get the right line, take the right line, for him to be successful in his first speech.
Fair enough. So is there anything else that went on Twitter or in the markets that you want to cover that we haven't already?
Well, how long have we? Yeah, we've gone 45 minutes.
Yeah, we should probably be wrapping up. This is your last. If there was one more thing, what would you choose?
Well, why don't you flick down the Twitter feed, and I'll find one last thing.
Well, I think perhaps the one that I haven't shared yet is this graph. I don't know if this was the one you were referring to.
Oh yeah, okay. Well, let's talk about this. It's just the fund flows really determine the direction of the markets, as we've mentioned before. And so valuation models have been, to say the least, imprecise about the direction of the market. But we need to stop and think. This is the Buffett measure of equity valuation, which is the total stock market capitalization relative to GDP. And you can see that currently we've created a new high spike in valuation, which is quite extraordinary. And we're now at a total cap twice the peak of the dot-com bubble in 2000. That is just astonishing. And but it speaks to the scale of the unwinding that could happen if they get the supply-demand balance incorrect in the markets. And I think hopefully we've covered the dynamics, the tools that they're using, and the risks around that, at least to some extent in this talk.
Right. I guess one thing I'd love to hear you explain a bit more is the statement that I've highlighted here. Since the 2008 financial crisis, the US stock market has grown 5 times the rate of the underlying economy. Just on the surface, that doesn't seem to make sense as to how that could be the case. So, how can the stock market grow so much more than the underlying economy? Like, how does that even make sense?
It makes sense because it hasn't outgrown the debt. In fact, it hasn't kept up with the debt. So the debt is feeding in there. It hasn't taken account of now, or until recently at least, $1 trillion of buybacks, which is shrinking the number of shares available to buy in the stock market at an extraordinary rate. The tax cuts, the liquidity management, which has been excessive. So all those factors have been prime features of the most extraordinary bull market, in America ever. Frankly, I think we can now say that. I mean, this has surpassed 1929, 1966, 68. We have never seen a valuation like this before. So it's critical that they get if it's critical for bulls that they somehow manage to engineer a better supply demand of cash flows going forward, despite the issuance of the IPOs and everything else that's going on. But it seems it's going to be extraordinarily difficult for them to achieve that. So you need to be aware, and there are all kinds of things you can do to manage portfolios in any circumstance with the right principles and the right approach, the right risk management. But it is a dangerous time, I think, for passive investors. For example, they're going to end up owning SpaceX because it's going to be one of the biggest market caps in the market. And I can't find anybody who agrees with the valuation. I did put something on the tweet about that valuation. But by default, it goes into people's portfolios, people's retirement portfolios. So just be aware of how you're actually investing and decide whether you're going to be preserving, protecting, and growing your purchasing power properly. So you're going to have a comfortable, enjoyable retirement.
Fair enough. I think that's a good closing message.
Right. Absolutely.
All right. Well, thank you for everyone who watches this in the future. We're continuing to go through, as my dad says every week, crazy market conditions. But we'll be back here next week, continuing to make sense of it all. Thank you for your
Great.
time and attention.
Thanks, Daniel.
Thank you. Bye.
Cheers.